What's up, guys? My name is Pete, and I'd like to welcome you to a holiday edition of Phipps Tips. In today's episode, we're going to take a look at the overall market. We're going to check out its top performers. We'll have a look at the day's biggest winners and the biggest losers. I got a news article today, guys. Amid the market chaos, our decentralized future is being built. How true is that? We'll find out. Then we're going to wrap it all up with a little bit of Bitcoin technical analysis on the 4-hour chart today, guys. Something a little different than normal. All that and more coming up. Stay tuned. We're on CoinMarketCap.com, guys. The market cap coming in at $314.6 billion with a 24-hour trading volume of $16 billion and Bitcoin dominance checking in at 39.5%. Market cap is down quite a bit from Friday, guys. Probably another $12 billion. Kind of scary what's going on. Of our top 5, Bitcoin down 0.77%, Ethereum down 6.75%, Ripple down 3.66%, Bitcoin Cash down 6.25%, and EOS down nearly 1%. Versus Bitcoin today, guys, we have MyBit token up 36.5%, Allsports coin up 21.93%, Polymath up 11.88%, Bitcoin Private up 8.8%, and CyberMiles rounding out the top 5 against Bitcoin up only 6.87%. Our gainers and losers of the days, guys, we have Silent Notary up 67.77%, Bizop up 43.23%, Patron up 41.78%, Docademic up 41.46%, and Cash AA up 40.5%. Our biggest losers today, guys, Fargo coin down 42.82%, Fitrova still losing, down 41.5%. Coin Poker down 26.16%, Earth Token down 25.81%, and EduCoin down 24.5%. So guys, we're going to move into our news article of the day. Our biggest winners and biggest losers, obviously everything's looking to be about the same as it does every other day. A little bit of red, a little bit of green. Stay tuned. In amid chaos, our decentralized future is being built. An article by Michael J. Casey. If, during CoinDesk's consensus conference in May of 2017, I'd predicted the crypto and blockchain industry's subsequent experiences, you wouldn't have believed me. Back then, CoinDesk's Bitcoin price index was around $2,400. 6 months later, it passed through $10,000 right when 1,300 investors and financial professionals attended the inaugural Consensus Invest Conference. But that was only a way station to $19,783, an all-time high in mid-December. This came as the Chicago Board of Trade, or COBE, and Chicago Mercantile Exchange, or the CME, launched Bitcoin futures contracts, giving professional entities a vehicle for betting on cryptocurrency. Come 2018, the entire mood shifted, however. Bitcoin lost 2/3 of its value in less than 4 months as regulatory clampdowns in China, South Korea, and US ensued. Bitcoin was not alone in this volatility either. In the 11 months following Consensus 2017, $8.3 billion was raised in initial coin offerings, according to CoinDesk's ICO tracker. At its peak in early January, the market capitalization for all crypto and digital tokens listed on CoinMarketCap surpassed $831 billion, a 900% rise from May of 2017. As Consensus 2018 wrapped up recently, it was at $375 billion. With all this money being made and lost, and the what the hell is going on questions it provoked among the general public, Bitcoin, cryptocurrencies, and blockchain technology were thrust into the headlines again. Suddenly, there were topics of conversations at dinner tables. mothers were asking their crypto-obsessed teenagers what coins to buy. And those of us who'd floated around the space for some years were looked upon with intrigue. Are you one of them? A Bitcoin millionaire? For the record, the author says, I mostly decided I am not. This level of public curiosity was totally new, but the market mania wasn't not for crypto. Ratio-wise, the BPI chart of 2017-2018 looks similar to the 12-month from April 30th, 2013, when Bitcoin started at $144.30, soared to $1,151.30 on December 4th of 2013, and then slid to $445 on April 30th, 2014, where it more or less stayed for the rest of the year. The same goes for the calendar year 2011, when the price started at 30 cents, peaked at nearly $30 on June 8th, and then closed the year at $4.25. I believed we were in a bubble in 2017, but we were also in a bubble in 2013 and in 2011. In those two cases, recovery to higher highs came much sooner than it did for, say, NASDAQ, which took 15 years to top its dot-com bubble peak of March 2000. The crypto markets may be redefining the nature of investment booms, speeding up the entire process of speculation, correction, retrenchment, and recovery. That would be something, guys. I mean, technology seems to go faster and faster and faster, so why shouldn't the redefining aspects of investment, keep pace with that? Under the hood, however, price is a distraction. It makes people miss the forest for the trees, overlooking the important innovations on which investment ideas were supposedly founded. So we must note that amid all the money mania, big changes were also occurring with the development of crypto technology itself. In the same 12-month period, the Bitcoin community's 3-year internecine war, otherwise known as block size debate, came to a divisive conclusion with a software hard fork to create Bitcoin Cash, a new competing version of Bitcoin with a larger block capacity that left the community that supported the original small block standard, now known as Bitcoin Core, free to incorporate code changes of its own. Most importantly, the segregated witness, or SegWit protocol upgrade was introduced, which streamlined data management and enabled other software improvements. In particular, SegWit facilitated one of the most exciting cryptocurrency innovations since Satoshi Nakamoto's white paper, the Lightning Network. Now live on Bitcoin, Litecoin, and other crypto, but still in its infancy, Lightning is an off-chain payment channel solution that promises to significantly increase transaction processing, enabling derivative-like smart contracts and lower costs. Not to be outdone, Ethereum developers introduced their own scaling initiatives. These include the Lightning-inspired Raiden and Plasma, which aim to enable smart contracts at massive scale. Meanwhile, new projects from Polkadot, Ripple, and Cosmos and others sought cross-blockchain interoperability, while still more worked on decentralized exchanges for custody-free token trading. Meanwhile, businesses, NGOs, and government agencies launched blockchain projects covering a smorgasbord of use cases. Almost every day, a new private or public collaboration was launched for supply chain management, digital identity, land titles, trade finance, commodity exchanges, decentralized electricity, or additive manufacturing. The UN, the IMF, and World Bank set up blockchain labs, consortia comprising established companies, startups, and even state governments and cities were formed to explore open source standards in energy, climate data, and the Internet of Things. People everywhere were striving to make blockchain go live. Many of these ideas were ahead of their time, mostly because the underlying infrastructure, the protocols and programming rules that govern platforms such as Bitcoin and Ethereum aren't sufficiently developed for them yet. That they are being proposed, but pressures on core blockchain developers. Unlike the mostly academic and publicly funded founders of the internet who worked for decades in relative obscurity before their work on packet switching and the transmission control and internet protocols was ready for online boom in the 90s, blockchain developers are in the spotlight. The world is already demanding applications while highly speculative crypto markets want returns on their money. Having hundreds of billions of dollars at stake does not make for an ideal, tranquil environment for testing and developing software. Still, developers have no choice. Like it or not, the ecosystem is coming together at once rather than in sequence. Programmers and cryptographers are working on cleaner code, designing smart security solutions and installing faster transaction mechanisms at or on top of the base protocol layer, while established companies and startups are rolling out smartphone products at the higher application level. All of this occurring as day traders flip in and out of multiple tokens, creating huge distracting gyrations in developers' own net worth. Out of this chaos, order will eventually come, however. It will partly be forced by regulators like the SEC or Securities and Exchange Commission, which will set up rules and enforce them, hopefully without killing innovation. Order will also come from the community itself, guys, driven by the demands of the market. We need best practices for token issuing startups, software audits and other quality assurances, and self-regulating governing bodies to encourage standards, adjudicate disputes, and disincentivize wrongdoing. We will be welcoming a bubble. Although the hysteria ensues, this industry's development won't chart a methodical straight line. The crazed market need not be viewed as a negative phenomenon. Throughout history, the arrival of transformative technologies has been accompanied by Wild West-like speculation. It happened with electricity, with railroads, and with the internet itself in the 90s. As the economist Carlota Perez explains, speculation and bubbles are not just byproducts, but are core features of how new, disruptive technologies are developed, deployed, and ultimately incorporated into our economy. Speculation unlocks cheap capital. Much of it just lines the pockets of early investors in crazy, overvalued proposals such as Pets.com in 1999, but also funds real, valuable infrastructure. In the dot-com bubble, money went into physical infrastructure, fiber optic cable, giant server farms, research into 3G mobile tech. People lost billions on silly ideas in the 90s, but their money also paid for infrastructure that would underlay Internet 2.0 post-bubble. It enabled algorithmic search, cloud computing, smartphones, social media, big data, and all other functionality that have changed our way of life and made a few titans of tech fabulously wealthy and powerful, i.e., like the Zuckerbergs of the world and the Bill Gates of the world. What's the equivalent now? The capital unleashed by crypto bubble isn't funding physical infrastructure, but social infrastructure. Token valuation might be out of whack with reality and imply big losses for many, but they're also incentivizing global groups of innovators to come together online, conceive of new decentralized economic models, and codify those ideas in open source software. Their startups may fail, but their code will be freely available for others to later work on, even more readily and cheaply than the dot-com era fiber helped Google, Facebook, and co. in the 2000s. We don't know what new innovations will emerge, but it's fair to say that these early innovators are laying the building blocks of our future, a decentralized economy. The big idea? At times like this, there's a broad understanding that something big is going. It's just hard to predict its economic impact, so people throw scattershot money at everything. Inevitably, their bets overshoot and price decline. That is, this is going on. Crypto is perhaps vindication of the underlying tech's importance. This raises some fundamental questions, however. What is the paradigm shift? The big idea that breeds such excitement? Why, After almost 10 years, is the market assigning $144 billion of value to a digital asset based on software system that has no one controlling it? What's so special anyway about a decentralized, censorship-resistant system of value exchange? The big underlying idea, I believe, says the author, is that blockchain tech can upend not just the business models of recent decades, but a millennia-old societal practice of deep significance to civilization. Its decentralized structure pretends a profound change in ledger keeping, a dramatic reimagination of society's methods for tracking and assigning value. It overturns the centralized model installed with the first ledger, the Code of Hammurabi, which was founded around 1754 BC in Babylon. It's hard to overstate how important ledgers are to our way of life. Without bookkeeping, modern society simply couldn't function. We'd have no idea of who owes what to whom and how much value to assign to the assets of individuals, companies, and entire economies. It's how we overcome the core challenge of mistrust among strangers. The means by which we reach agreements on sets of facts and make exchange of value. This is the stuff of civilization. Anything that transforms this function is, by definition, extremely important. Until now, we've had to rely on centralized ledgers keepers, essentially requiring us to trust the say-so of those who control the books. We've assigned regulators and auditors to randomly check their work, but for the most part, we are blind to the accuracy of the data, beholden to what the bookkeeper tells us. Excuse me. This siloed record-keeping results in a cost of trust that takes many forms. One is found in financial crises, such as that of 2008, when society lost faith in the ledgers produced by banks, such as Lehman Brothers and Royal Banks of Scotland. And because of that, guys, we saw a huge market crash in 2008. Another is less obvious: the endless work of millions of accountants and businesses around the world, each reconciling their company's books to those of their counterparties. Why? Because they don't trust each other. Blockchains promise to supplant this centralized approach with a distributed shared ledger whose updates follow a robust, ongoing consensus in real time. At any given time, everyone who's with access can know the current state of agreed-to transactions and balances. No more need for weekly, monthly, quarterly, or annually reconciliations and audits. The entire rhythm of our financial system could change. And it's not just financial data. Valuable information of all kinds can be tracked in this decentralized manner. It includes the online data that defines digital identities, title assets, and compliance information. It could disintermediate middlemen as all stripes, because having a decentralized algorithm resolves our mutual mistrust rather than depending on an all-knowing centralized ledger keepers. We can trade directly with each other. When this system is reliably attached to trusted devices in the Internet of Things, it could even allow for machine-to-machine trade. Such a transformation points to unimaginable new efficiencies. It could create untold new forms of value, and it could massively disrupt existing businesses and jobs. These prospects have stirred a hive mind of dreamers and fueled an unprecedented bout of economic speculation. We don't know where it's headed, but we sense something profound is afoot. Blockchain is a software tech, but its sweeping potential has fostered a giant sidelined industry of speculation and ideation. As the technology goes live, this hurly-burly process of creative innovation and destruction will only intensify. That's both exciting and daunting, but it poses massive potential payoffs. Join us for the ride. So guys, it was a rather lengthy article there, but what it boils down to saying is, amid, all the price craze and, money flowing into and out of crypto on a day-to-day basis, we can't forget that 99% of these cryptocurrencies outside of Bitcoin are their technologies. They are looking to solve problems with the blockchain. And if you can get behind the projects that you think will be the ones, that will be integrated into day-to-day life, such as like your Ripples or your IOTAs, or like your Polymath, anything that helps build the infrastructure of the blockchain community, guys, those will be the coins, or like the businesses, I shouldn't say the coins, the businesses that will, make it through the end of the day. Like these businesses won't be the pets.com of the blockchain era. These will be your Facebooks and your Googles. So it's just something to keep in mind, guys. When you are wanting to invest into crypto and into this space, make sure you know what you're investing in. Do your research. Invest in companies that you believe in, that you think that will, make it the next 5 years, the next 10 years, the next 20 years, that have a plan that's going to be successful. Just keep in mind, guys, that like a lot of this market is still speculative. So, just be safe in your investing. And when you do invest, as I said, this market is speculative, so be prepared, guys, to lose whatever it is you invest. Just, it's not going to be, just throw it in and come back and check it in 6 months, because, it may not be there. Just something to keep in mind, guys. We're going to move on to our technical analysis. Stay tuned. And here we are, guys, on the Bitcoin versus US dollar 4-hour scale using the Bitfinex exchange information. And I wanted to change it up a little bit today, guys, using the 4-hour scale. We get to see a few more patterns this way. Maybe we can see exactly, or at least I wouldn't say exactly, but we'll try to hash out exactly what Bitcoin's going to try to do from here. We can see a few more trends and stuff a little easier here. Like already, guys, I see like our down right there. Move that out like that. Our trend line here that we are currently bouncing on, up and down, up and down, and up and down. As you can see, like our wicks are punching through, but they aren't stopping. They aren't crashing through. They're being pulled back up, which is a good sign. It's a very good sign. What we do have here today, guys, I want to grab our drawing tool, and we currently have like a little bear pennant. Draw here, and we'll take, like so. And I want to zoom in here, guys, and you see these wicks. You see these wicks here on these candles. You kind of draw in like this and take like that, like so. And you see how we kind of have what looks to be like a little pennant or a flag. And it's in a bearish formation, so that means, guys, that obviously we're going to have a drop, and we did. We had a red candle about 4 o'clock this morning, it looks like. So, there's that to watch for. But what we did have at 8 a.m. today, guys, we had a red doji appear on the 4-hour scale, which, as I've told you guys before, previously, dojis represent reversals in the trend. So, was, let's say, 7,200 our bottom? And by bottom, guys, I mean, is that the line that we're going to bounce off of and head back upward? Well, currently it is 10 o'clock in the morning Eastern time, and we have a very nice looking green candle forming on the 4-hour chart. So that's a good sign. It still has about an hour and a half left, and we'll see what happens from there. But I'm going to turn auto on and zoom us back out here, guys. So, but we can see here, ladies and gents, that we do have that. Actually, it's been 2 in a row. I'm going to draw this one in here. We've had 2 of these pennants in a row, guys, like there, which broke up and then immediately fell down, and we formed another pennant and we fell down. We're breaking up again. So what could be happening here, guys, and I don't want to say it, but the same thing happened here. We moved up, but then we immediately broke down and formed another pennant. So what we could expect here is another breakdown after this green candle, and it will form yet another bear pennant, and we could be looking at another low shot hitting down this way, like into the 7,000 area, like the 7,000, high 6,000, right around there roughly. We'll be bouncing in that area, possibly. I'm not really sure. That's just going off of these indicators, or not these indicators, but these trends, I should say. We're going to remove all those drawing tools so we can get back into looking just directly. But from here, guys, we don't see, well, we do. If we zoom out, we can see the triangle still, like the big triangle that we had formed earlier, like Friday when I had talked to you guys about it. And we're still forming that. And that's something that we don't want to see complete, guys, because if we do, that it's going to be disastrous. Absolutely disastrous, because this is a huge falling triangle. Absolutely huge. Like, it encompasses nearly all the price action for, oh, I don't know, all this year? Yeah, so far, all of this has been what's happening this year. So, we could assume that it's going to continue its downward path. That's what we can assume from just seeing, you know, the trend that we're following currently. Like so. Now, if we see Bitcoin end this right here and bounce and come back up, we can roughly assume, guys, that it will take this sort of pattern. It will bounce here, up, will not penetrate, will bounce, will not penetrate, and will do this. That is what this pattern signifies, and what will ultimately happen if it's left to do what it's doing. So, just something to keep in mind, guys. If you are wanting to trade, and I'm going to use this time right here to announce that I am not a financial advisor. I am making my disclaimer right now. This is not to be taken as financial or trade advice. This is just for educational purposes only, guys. With that being said, don't trade Bitcoin. Don't trade Bitcoin. I see so many people tell me, oh, we're getting into short positions on Bitcoin. We're doing long positions on Bitcoin. Well, that's all fun and great, guys. Bitcoin isn't where you're going to make your money, especially in trading. You want the... I personally, I'm not a shorter, I like to long my positions. So I like to look for coins that are in the deep red that I know are about to bounce back, and then get in on them and then just ride them up until they retrace, then get out, wait for the retrace, get in, ride up again. That is the way I like to do my trading. I'm too scared to try to short, because you can potentially owe people a lot of money on a failed short trade if you forget to put in your stop loss. But with that in mind, guys, that's going to do it for the video. If you're still with me after all this time, hit that subscribe button, as I'll try to post a video every single day, Monday through Friday. If you learned anything today, guys, hit that like button and share it with a friend. As always, thanks for watching, and I'll see you in the next one. Peace.